For the past few months, most of the headlines and most of the YouTube channels you are watching are saying like job data is really weakening and the inflation is not in our control, or maybe the Federal Reserve is not cutting rate yet and they are kind of clueless right now, kind of stuff, right? So this is actually happening in every week and literally formed a puzzle here. But there is something interesting on all the story being told for the past weeks and months. There is actually a name for this. And I didn't see most of the headlines are mentioning about this. It's actually stagflation. It is the situation where the economic growth will be pretty slow and job will weaken, while on the other hand, the inflation refuses to fully disappear. In the normal condition, when the economic growth becomes very slow, the Federal Reserve has a one tool, that's rate cut. So they will cut rates and eventually market will follow and recover fast, like in a dot-com bubble in 2000s and 2008 financial crisis and the COVID recession. But this is actually an entirely different story here. The last time the US experienced this kind of situation, like the stagflation situation, is in 70s, like at the time of Vietnam War. At that point, the stagflation situation only ended where the poll worker pushed the interest rate to like 20%, where that actually triggered a huge recession and it finally broke the inflation situation. So the real question here is that are we actually entering to the same stagflation situation right now? If it is true, and how to navigate it. If you really look into the data, stagflation will only happen when there are four signals matches. The first one is economic growth will become pretty slow. The second, even though the economic growth is pretty slow, the inflation doesn't fall. And the third, a sudden supply shock. And the fourth, the central bank will reach into a confused situation where they don't have any idea whether they want to fight the inflation or they want to support the growth. Right now, the two signals are already there in the market, like the slow growth of economy and the inflation. And the third problem that could emerge when the Strait of Hormuz tension will increase, like the war of Iran and US become much more stronger. So the fourth one is a major question here, the response from the Federal Reserve. So for that, you need to wait till the March 18th. So that's why we are making this video before March 18th. So what actually we are going through this video is, so we will go through these four conditions of stagflation one by one with a fact check with the real data, and we will compare that with 1970s situation and how they progressed to get a better understanding of all the situation. So we are not going to predict the entire future. So instead we will consider the 70s situations as a reference point, and that will help us to create a better mental model for what actually going to develop in this economy right now. By the end of this video, you will get a framework or a thesis to work on this stagflation situation that actually gonna emerge in the market, and you will get a better understanding of how the big investors will move in this economic situation. So I think all get lined up. So let's get into the real data right now. So let's get into the condition one. The condition one is economic slowdown. As of February, jobs report showed that US economy just lost around 92k jobs, and most of the economists were expecting around 50k new jobs opening in the market. If you go much more deeper, the manufacturing industry has been losing job for a year right now, and people who lost job is getting more time to get into another one. And if you look back to the 1973, back then the job market were pretty strong at that time, but underneath the surface, the growth was already started to weaken. Like the industrial production has been started to weaken, and years of spending for the Vietnam War already stretched the part of the economy there. So in the both conditions, the slowdown was already there, but it didn't become the headlines yet. That's the key point here. Slowdown often start as a background signal long before the main story actually going to happen. So condition one is validated with the data right now. Now let's look into the condition two, the inflation. So in the case of inflation, the economic slowdown was already there, but in the perspective of inflation, that picture look entirely different here. According to January CPI report, its inflation is around 2.4%, and it made most of the market much more in a relaxed mode. At first glance, it looked entirely normal, like inflation is under control. But if you combine this with the condition one, the economic slowdown, whenever the economic growth began to slow down, the inflation falls very quickly. Interestingly, that's not happened here right now. So for that reason, we may be looking into the two data points. At first, let's go back to 2020. During the COVID pandemic, government and central banks just injected massive stimuli in the economy, and they expanded the money supply as fastest pace in the decades. And that wave of liquidity just actually stabilized the market, but it actually created a condition for the inflation that going to happen in the future. And the second chart, this chart has two layers, CPI and PPI. The blue line is CPI, the price consumers pays, and the PPI, the cost for the business that actually appear in the early supply chain. If you look into the historical data, the producer cost increase just often comes few months before the consumer price surges. And if you look into the data right now, the producer's cost has started rising again. In this situation, the tricky thing we need to consider is that even though PPI is increasing, business don't rise the price immediately. Instead, they actually absorb the pressure using the inventory or cutting the margins or waiting to see the cost increase is temporary or not. And economists already call this as a cost pass-through. But eventually, this cost will move from producers to consumers. If you look into the 73 pattern, the economic growth was pretty slow, but inflation didn't fall with it. Just like we experienced the COVID situation in the 2020, at that time US had another problem, the Vietnam War. Years of heavy government spending on the Vietnam War just forced the government to print more money. So at that point, the economic growth was pretty slow. The inflation pressure was already building upon the economy because of this forced expansion of money. The condition 3, the supply shock. The last week, there's a geopolitical conflict just entered in the market right now. About like 20% of the oil supply is currently moving to the Strait of Hormuz. Now the traffic through that way is reduced around 90% right now. At the same time, the price of Brent crude just went from $70 to like 80%. Just because of this war escalation just happened in the past couple of weeks. And the same kind of situation just already happened in the 70s. At the same time, OPEC, the major oil producing countries that coordinated the global oil supply, restricted the exports. The price goes much more higher at that situation. But the real damage is not about the increasing the price, it's about how quickly the price is just moved. Oil didn't gradually climb over the years, it actually spiked for the short time period. That's the speed that actually causing the entire shock in the economic system. Now the condition 4, the Fed. The three conditions are now visible right now. The growth is slowing and the inflation is not fully falling and the energy costs are rising again. And that brings us to the fourth point, the Federal Reserve. Now its two mandates are just pulling in an opposite direction right now. A weakening labor market just arguing for a more cuts. On other perspective, the inflation is keeping the rate high. The interesting thing has the Fed as a one main tool, the interest rates. And that single tool can't solve the both problem at the same time. And at the 1970s, the same situation made Fed stuck between these two problems. For years, policy having moved a little bit and they are literally kind of confused stage. And finally, that got solved in 1979, where Paul Volcker just increased the rate to like 20% by accepting the deep recession. And that deep recession situation made inflation under control. So what should you watch next? Two dates matters here. The first one is March 12th CPI report, where we can identify whether the inflation is still exists in the market. And the other one is March 18th Federal Reserve decision. So the main thing is that in the March 12th report, if inflation was much more higher, then the Federal Reserve have to hold the rates or increase much more higher, just like they did in 1970s. And one of the most important questions we need to ask here is that currently we know the Federal Reserve is literally in an uncertain situation. So in this situation, the real investors will literally avoid assets. They are more dependent on the interest rates. So the investors will look into the real world assets, where the asset with real intrinsic values like gold or agriculture or silver or metals and even Bitcoin itself. But we can't consider Bitcoin right now because still Bitcoin is heavily dependent on the liquidity and the interest rate. Anyway, we need to do much more deeper research on that. If you really need that video, like what are the assets you can hold in this stagflation situation, we will create another video regarding that. Let me know in the comment section. So I think you got an understanding of this video. So you got a mental model to prepare for the next couple of months. So I will see you in the next video.